More live. Yo, what's up, people? We gonna make it. We gonna make it. We gonna make it. All right. What's up? Hey, tonight I got my man Tony C. the Cannon. It's your boy, Mr. Trader Die, and we're doing a continuation of last night podcast. Last night the key word was what, Cannon?
EFTs.
Diversification.
You
DFTs.
can't ask me, man. I'm just here to
Diversification.
look good.
All right, people. So what? Remember, diversification was what? Not placing all our eggs in different baskets. That's like a simple way of knowing it. It's also spreading around your portfolio to minimize the risk or to balance your risk. So you
Hmm.
always want to diversify, diversify, diversify. We will always beat that in your head here at Trader Die. So there was different types of ways to diversify. We went over index funds, mutual funds. So like as we discussed, the index fund is basically a fund that's tied to an index. And what's the different type of indexes? We had the Dow 30, the Dow Jones, the S&P 500. There was all type of indexes that go on. So then we went to the other type of ways to diversify funds was the mutual fund. Now the mutual fund was kind of different than an index fund because with the index fund you had to buy into it with your own money, with your own investment. Whereas with a mutual fund is you and however many investors are in that specific fund, you're pulling your money together. And you guys, your portfolio is being managed by a professional who's paid to buy and share those stocks actively. Now we're gonna get into something to the third type of fund. Now this third type of fund, it is like it's an actual fund, but it has it has the characteristics of stock traders. So you're able to day trade it, but there's also is diversification because you're buying into a fund. You're buying multiple shares. You're buying shares into multiple companies. And this is called an ETF. And what is an ETF, they ask? An ETF is an exchange traded fund. Now, basically, as I just said, an ETF gives you the ease of stock trading, but the diversification benefits of a mutual fund. Basically, an ETF is a basket of stocks, securities, bonds, commodities, or some combination of these that you're able to buy and sell through a broker. As I just said multiple times previously, the ETF offers the best attributes of the two popular assets. They have the diversification of a mutual fund, but they're really easy to trade, like a stock itself, like a very simple stock. Like basically, an ETF is a fund that's able to be traded on an exchange, hence the name Exchange Traded Fund (ETF). As I always say, people, one thing with the stock market, you guys want to learn the terminology and the root words, because once we learn the root words and the root terminology, everything will get better. Like ETF, Exchange Traded Fund, a fund traded on an exchange. Let's not make anything harder what it needs to be. So yeah, like all funds, as I said previously, an ETF allows you to buy or sell a basket of assets, whether that's all stocks, all bonds, or stocks and bonds, whatever the ETF is, you're able to buy and get all those assets, but you don't have to track them individually. This that's like all funds, like I just said, for the index fund, the mutual fund, and now the ETF, exchange traded fund. Like again, people, diversification. That is the key word. So basically, an ETF works like this: the fund provider owns the underlying assets. So the fund provider will be, let's see, Vanguard for this matter. So they have the assets, but they design a fund to track those assets, and then they sell those shares to the investors. So basically, when you're buying to an ETF, you own a portion of the ETF, but you don't own the assets that's in the ETF. For example, if you buy an ETF that tracks the S&P 500, you don't exactly own shares of the S&P 500. You just own shares in an ETF that tracks the S&P 500. That being said, even so, the investors in the ETF, that tracks like index such as the S&P 500, they actually get lump. They get the lump, the dividends and the repayments and the reinvestments, same as you did if you own the stock. So in the way, it's like owning a stock because you get the payments and all. Okay, now why ETF is designed to track the value of an underlying asset, whether, like I just said, a stock, a bond, a commodity, a currency, anything. They normally trade at market determined prices that deviate from the actual price of the ETF. Now, you may be confused. Now, let me further explain. For example, the share price of an ETF is largely determined by the underlying value of the portfolio, otherwise known as the net asset value, which is basically that's just all the shares in the ETF is added up, and that's what's the net value, the net asset value. Whereas the market price of the ETF is the price that investors can buy or sell that ETF on an exchange. See, like I just said before, the market price, it will deviate from the NAV or net asset value on the ETF depending on the supply and demand for that ETF at that point in time. So if you guys confused, let me give you an example. It's like imagine an American based ETF, but it had exposure to Japanese stocks. So basically, it's like an ETF, but it has foreign companies in that ETF that make it part of that fund. So since the ETF is based on the New York Stock Exchange, it's going to be from the hours from 9 to 4. The shares in that ETF are based on American companies or American hours. So, but since their shares of that ETF is listed on a foreign stock exchange, those shares are not going to be counted during the hours of 9 to 4 because that isn't the business hours. Those shares are traded on the Japanese stock exchange. So that right there is an example of why the share price of an ETF and the NAV asset price, it won't be the same. See, funds, they're like, as I said before, a fund is made up of all types of assets with stocks, bonds, commodities. It's like a combination. Some are here in America, some are based overseas. So that's like a perfect example why the price of an ETF and the asset value of the ETF will not be the same. It's going to be deviation. Now, there's two terms that you constantly hear about when you're discussing the ETF. That is a premium and a discount. And basically, when the ETF is at its premium, it's when the price, it's when the price of the ETF was bought and sold at the market price exceeds its NAV, which is net asset value. Whereas when an ETF is at a discount, that's when the price is bought and sold, its market price is below the net asset value. So other than that, now, how do you select the right ETF? Now, that's a great question. Like every fund, mutual fund, index fund, exchange traded fund, you want to know your investment objective. Like, do you want to grow wealth over the long term, or do you want to be a short term day trader with the ETF, or do you want to make income like a retiree? So you have like options. So let's see for the first one. If our first choice would be long term growth. So these ETFs I'm going to give you right now, exchange traded funds, are funds that was great for long term growth. This is the ultimate buy and hold approach. This is what the old money on Wall Street teaches. You buy and you hold. You buy it and you just hold it for a while. Okay, so let's see here. The first ETF is the Vanguard S&P 500, otherwise VOO. I'm sorry, I forgot to explain this earlier. And another thing that ETFs have in common with stocks, they're listed by their ticker symbol. Like say Apple is AAPL, or Amazon I think is AMZN, I think. So ETFs are the same way. So when you check an ETF, you don't have to look for the whole name of the fund, such as the Vanguard S&P 500 ETF. You will look for the VOO. That's the ETF ticker symbol. So yeah, as the name implies, the Vanguard 500 ETF tracks a Standard and Poor 500. And that's a great indicator of the total American economy because it's 500. Like some people say the Dow is better because the Dow tracks the 30 largest companies, whereas the S&P it tracks the top 500 companies. So that's more of a broader base view. So yeah, with the Vanguard S&P 500, you're tracking 500 companies. Diversification, and also, as I said on previous podcasts multiple times, Ford is F. Yeah, as I said on podcast multiple times, that the Standard and Poor just came off a long bull run, like a very long bull run, which is an upswing. Always remember, this is just like a primer on technical terms we're gonna get into later. Bull run, bull market, or anything bull means buyers. It means going up early, going up basically. Bear market, bear swing, downturn. That's prices are going down. That's pretty much it. But yeah, the S&P was just off a long bull run, man. So that was a great opportunity for long-term growth. Another ETF is good for long-term growth would be the Vanguard 2000 ETF. Ticker symbol was VTWO. This is basically a small cap ETF. It tracks the 2,000 small caps. It gives an investor a chance to participate in higher growth potential because you're dealing with small caps, which have more growth potential. While while also you're doing broad diversification because you're investing in 2,000 stocks. So that'll be a great long-term investment. Again, you're dealing with small caps, all type of growth potential, and the diversification is going to come from this 2,000 stocks in that fund. So you just bought shares in 2,000 companies. And another great ETF for long-term growth. This might be the best one actually. This one, as I said you guys previously on every podcast I'm on, that I actually day trade. I'm not really a fund trader, but doing the research for you guys on this fund, I learned some stuff about some index fund. Some ETFs. So I think I might invest in a couple. And this is one I might invest in. All right, this is called the Vanguard Total International Stock Index. VXUS is the ticker symbol. Again, VXUS. This ETF owns 90% of the non-US stocks on the planet. Think about that. 90% of the stocks on the planet it covers. So that's small caps, large caps, emerging, developed markets, in every sector imaginable. So that's crazy because it owns every non-US US stock. It provides a hedge against if our economy goes down. It provides a hedge, which means it's like a counterweight against a downturn in the American economy. The only bad thing about this ETF is the current situation where we're in, where it's a global economic downturn. So it doesn't matter where you're at, everything's going down. But again, this environment we're in is not really necessary. It's not the terms are conducive to trade an ETF, but you should do your research now because the research is. The upturn is going to come. We're going to switch from a bear back to a bull market, and prices will stabilize. And now this is the time to do your research. So when the prices stabilize and we go from bear to bull, you can start checking out these funds. And I'm telling you guys, the VXUS, that is a good fund to invest in. Again, it provides a hedge against the downswing in the American economy, and it also has the upside for global growth. Now, as I say, it deals with emerging and developed markets. China and India are the world's two largest developing countries, two largest developing economies. So this VXUS is heavily weighted for those two emerging markets. So that's great long-term growth. And the fourth ETF for long-term growth is the Vanguard Value ETF. Stock symbol VTV. As the name implies, this is a value This index is great for long-term growth because it searches for value stocks. As I said multiple times on previous podcasts, a value stock is a stock with great fundamentals or good to great fundamentals, but it's trading far below its market value or its fair value. So if this ETF is made up of nothing but value stocks, that's like common sense. That's just a great long-term growth because all the stocks in that fund are great stocks. They're just sold at a price below what they should be sold. So from the outside looking in, that's like a no-brainer. You might as well jump on that, and it actually uses the like 3 podcasts ago, I gave you guys like 3 or 4 important fundamental analysis ratios. And these are the ratios. These are the exact ratios that they use to screen stocks for this ETF. So people understand that fundamental analysis is of utmost importance. It would behoove you guys to learn those. But the ratios was price to book ratio, price to sales ratios, and the price to earning ratio, also known as the multiple. And we went over that like 3 podcasts ago. We can do it again if you guys want to. Just like I say, send me any podcast requests at TRADEorDIE.LIFE@gmail.com or right here on Facebook at TRADEorDIE.LIFE or my Facebook page I think it's TRADEorDIE38 actually on Facebook. Yeah, send any requests. You guys got any special requests, and that's when we can start doing a podcast on. Okay, now we're gonna go to some good ETFs that you want to day trade on. That got my attention. I was like, wow, day trade ETF. All right, so the first one again is the Vanguard S&P 500. And this ETF is very fluent, man. It's gonna pop up in a bunch of different screeners because again it tracks the S&P 500. That's 500 companies it's going to track. So it's going to be great for long-term growth because, as I said before, the S&P, which is a barometer of our economy, is always going up. I mean now obviously we're in a downturn, but in a normal trading environment, markets they inherently go up. Like you look at any stock chart from like back in 1950 until this time, it's going to be a continuous line up. I mean, you're going to have your little down swings, but overall they're going to go up. So that's why the S&P 500 is always going to be a good investment for a long term. But what makes a good term for day trading is the term I always give you guys: liquidity. Now, the last couple podcasts I was talking about in order to get my assets to between illiquid assets and liquid assets. How fast can I get the assets? With this in this example, this is how many shares are bought and sold. Again, people, I cannot stress that in the economic world, liquidity is a big term. It's very important. But here though, this is for shares. See, it has 2.6 million shares bought and sold daily. That is a lot of liquidity. 2.6 million. That's perfect for a day trader. So it has more than enough of volatility also. And again, that is the Vanguard S&P 500 ETF, otherwise known as the VOO. That is the ticker symbol. Our next one is Vanguard. As we all know, Vanguard is a great fund company because those was the best. That name kept coming up when I was doing the research. Again, but the Vanguard Total Stock Market ETF, VTI, is that ticker symbol. This index tracks the performance of the U.S. Total Market Index. It's kind of, you remember last night when I talked about the Wilshire 5000 Index, which tracks the complete stock market. Well, this fund does that, but it's not an index fund. This is a ETF fund. So there's different variations, but it kind of must do the same thing. So yeah, this index, like I say, it's a performance of the total market, which tracks the large cap, mid cap, small cap, and as we said before, capitalization. Large cap, mid cap, small cap, micro cap. That is the total amount of shares outstanding multiplied by the price of the asset. So just say, for example, Apple Computers. All right, people. Apple Computers sells for $5, right? And they have 10 million outstanding shares. their capitalization would be 10 times 5. If $50 million, that's their capitalization. So when you want to know the capitalization of a stock, is basically just the current price times the number of outstanding shares. So yeah, like I was saying though, this ETF tracks large cap, small cap, mid cap, tracks stocks on the NYSE, the New York Stock Exchange, and the Nasdaq. It's, it shows every stock in the American economy. This ETF allows a trader to bet on a total market movement. So you see the market from a broader spectrum. So, and you're doing it across multiple market cap sectors. So, and it has an average daily trading volume of 3.6 million shares, people. Liquidity, liquidity, liquidity. You can buy and sell all day long. That is a great ETF for day trading. That's perfect, actually. You see the whole market. You can see every sector, every form of the market. And it's 3.6 million shares bought and sold on a daily basis. You really can't lose with that. Okay. Another great ETF to day trade is the Schwab. That's the first one that wasn't Vanguard. Like Vanguard got the game locked. But Schwab, the US broad market ETF. Now this is the same as the previous one. It's the same as a broad level based market. It's a broad level market based ETF, which means that it's covering multiple sectors, multiple capitalizations, market cap sectors, I should say, instead of capitalization. It's covering through small cap, mid cap, large cap. That's different market capitalization sectors. This index includes the top 2,500 traded companies in the USA. So it's like the S&P 500 times 5. Instead of doing 500, it does 2,500. So this ETF has an average trading volume of around 1 million shares. So that's another great candidate for day trading. So there was two type of categories, and the third one, I'm sorry, the two type I just covered was the best ETFs for long-term growth. That's buy and hold. You buy at this price and you wait until the price goes up and you sell at this price. That's buy and hold, the perfect strategy. Then I'm a day trader, so I gave you guys some ETFs to day trade on. Now I had examples and all. And let me go over what an ETF is and what the history of the ETF is. You sure? All right. So we see right here the history of an ETF. It was created in Canada. Man, Canada was good for something. Only thing I like from Canada is like Drake and beer. And now ETFs. All right, Canada, keep it moving. All right, so yeah, the first one and they started here in North America was the S&P, which was 1993. The S&P Depository Receipt (SPDR) is the true beginning of the ETF industry again because that stuff in Canada really don't count. So 1999, the Asians got into the ETF. 2001, the Europeans got into it. Let's see here. By 2002, there was 246 ETFs available around the world. 7 years later, 1,000 ETFs was traded on U.S. exchanges alone. 5 years from that, 1,500 plus ETFs with over $2 trillion in assets. That's a lot of money in them ETFs, people. You should check them out. 2016, that was the last example I could find. That's 4 years ago. Almost 5,000 ETFs. What is it? 4,779. Let's round up. Let's say 5,000 with a sum of $3 trillion. Okay. Why invest in an ETF? I'm glad you asked. Let's see here. You can buy and sell any time of the day, just like a stock. That's why it has the benefits. It's like a stock. You can day trade, buy, sell as much time as you want. No sales load, but it has a lower brokerage commission. It's more tax efficient. And again, unlike a mutual fund, you can place a variety of types of orders, a limit order, which means you can buy at a certain price. I'm going to get into that later, which differs from a market order, which means you buy at the price where it's currently at. That is the price that is set on the market. Whereas a limit order, you can place where you want to buy in. For let's say a quick example. If Apple Computers at $5, but you want to buy in at 503, you will place your limit order at $5.03. Whereas if you bought at $5, that would be called a market order because you bought that at the rate of the market. All right, yeah. You can move in and out of markets quickly, hoping to catch short-term swings like a hedge. Basically, all the pros of the ETF is basically it's short-term trading. It's the same as a stock. Like these are all the benefits. It's like a stock. You're able to invest using stock index and bonds and ETFs, and I mean it's all stocks. Now the cons, some thinly traded ETFs have wide bid and ask spreads. That's again, people. What is that? When something is thinly traded, what is the term? It has no liquidity. It is illiquid. We stay away from markets that have no liquidity or illiquid. So any ETFs that's thinly traded, it's going to be harder to buy and sell them because they're not bought and sold that much. So investors are not going to be really in a rush to buy them, when they're offered. So they're going to have really high spreads because you got to cover that price. We're going to get into the spread. Actually, I should have been did that. The bid and the ask. That's like the basic stock trade. I can't believe I didn't do that. That's going to be our next podcast coming up in a couple ones. All right. ETFs track their underlying index fairly well, but technical issues can create this discrepancies. Like I told you about earlier, with an ETF is based in one country, but it has assets. It tracks assets from other country. That right there is going to cause deviation between the net asset value and the price where it's sold at. Is market price. That's basic. That's like the number one reason why. If it's based in one country, but it tracks assets in another country, that means when the host country stock market is open, the assets that's in some other country, it cannot track because it's not on that exchange during the time it's open. So that right there is going to cause a price deviation. That's not a bad thing, but that's something that you want to keep track of when you want to invest in an ETF. I think that throws off a lot of potential investors in ETFs well, hold on. If I add up all the assets and the price is this, but the price being sold is this, like that doesn't make sense. So you always want to just keep that in mind, ladies and gents and ladies. And on that note, it's about that time. It's 27 minutes. I've been rambling on. I just hope you guys got something out of these podcasts. I wanted to do one about funds though, because a lot of people didn't know the difference between an index fund, a mutual fund, and an ETF. And basically, the index fund and the ETFs, exchange traded funds, those are the best options. I feel like because a mutual fund has its benefits, but it normally has a higher rate to buy in, or let's say a higher minimum deposit instead of the buy in. I think minimum deposit is better. It has way more fees, and it's just I feel like an index fund and an ETF is better for a potential investor. Because it's like I just said, you have a lower minimum investment and there's not as much fees. And it's also, I mean, that's great, for potential. Those two reasons right there was have me anyway. If I was new at the market, I'm like, well, all three funds basically do the same thing. But this fund here, this mutual fund, I have to pay more fees. Even if my fund goes down, I still got to pay more money. Like, oh, wait. And then it has a higher deposit. It has a higher balance, minimum balance. It was like, okay, so these two funds, index fund, exchange traded fund, they basically do the same thing, but I can pay less money to get into, and there's less fees. It's like, why even go to mutual funds? But some people like mutual funds, and I'm not here to talk you out of mutual funds. I'm here to say there's alternatives to a mutual fund. Like some people just swear by their whole entire beings that mutual funds is where it's at, and it is not where it's at, people. Especially in an economy like this, I know there's all kind of people that's how can I say this the right way? They're they're getting hammered right now. Those funds, those mutual funds are getting hammered, and they still paying fees. See, if you was in the index fund or ETF, you yourself basically manages those funds. I mean, I'm sorry, you don't manage them, but you just press buy or sell. You control if you want to go long or short, so you can step out your positions. Whereas with the fund, with the mutual fund, you have to call the guy your broker and tell him what to do. Sometimes the brokers for the funds, they do what they want to do. They do what they think is better for you because it's their job to manage your money. So sometimes they manage your money like it's their money, and they do what they want to do instead of what you want to do. So, let's say that if you wanted long term growth, your fund manager might want to day trade your money, and it's like, whoa, you're just going against everything I said, and so that's the biggest con to me about a mutual fund. You really don't have control. Someone else is buying and selling. But if you don't have any experience, and when you want to get into the market, then mutual fund where it's at. All right, people, it's about that time. What is it? It's 31 minutes in. Hear me ramble on. It's your boy Trader Die here. My man Tony C. the Cannon. I don't know where he went. He left me alone tonight, so I had to ramble on. I felt like I did a lot better. Hearing got my notes. And remember, people, we gonna make it. We gonna make it. It's your boy Trader Die. So yo, check me out, man. TRADEorDIE.LIFE at YouTube, TRADEor.38 Facebook, TRADEorDIE.LIFE@gmail.com. Or any questions, help you guys out. That's what we do here, man. On that note, I'm out, and remember, man, we gonna make it.